You're welcome to this channel. We're looking at ACC102, Elements of Bookkeeping 2. All right, bookkeeping is a part of accounting, as you may have already know, or will soon know in the course of this class. So ACC102 has the following study units from Unit 1 Basic Accounting to Unit 15 Elementary Break-Even Analysis. So we have a lot to learn in this course, but for now we'll be looking at Unit 1 Basic Accounting. Right, accounting is concerned basically with accountability, just like from that word accounting. We want to ensure accountability. We want to be able to present the finances of the organization in a way that the interested parties in the organization will be able to know what is going on. As you continue your study in the field of accounting, you are going to learn about the agency theory, that the directors of an organization, they are actually agents of the principal. Okay, and the principals are basically the shareholders, the owners of the company. So for the owners of the company to be able to know what is going on, the agents have to prepare regular financial records, okay, to be able to show the owners and other stakeholders what has been happening financially in the organization. So the underlying purpose of accounting is to provide financial information about an economic entity. Historical development of accounting. There was an Italian monk called Lucia Pacioli, and of course, as an accounting student or a student of accounting course, you must remember that name. That is the father of modern accounting, Lucia Pacioli. He published a book in 1494 titled Summa do Arithmetico Geometrica Proportioni e Proportionalita. All right, that is the name of that book. And that is the book that first officially introduced the double entry system, which we will soon learn about also. So for every debit, there must be a credit. Every transaction, there must be two entries, okay? You pass a debit, you pass a credit. It became necessary for managers to report to the owners of their business activities during the period under review. Such reports mainly include the following: how the financial resources of the business have been invested during the period. Okay, did we invest in new machineries? Did you buy financial assets? So we need to be able to show that in the books. Number two, the profit earned or loss incurred during the period, and the asset, liabilities, and owner's equity at the end of the period under review. So the financial statement should be able to show us all this information as accurately as possible. Now let's look at regulatory framework. The accounting field is a highly regulated field because, you know, anything that concerns money, there is always that temptation for people, right, to maybe do what is not really ethical. So all over the world, you have governments, you have accounting bodies that always ensure that the people, accountants, and the organizations, managements, they follow rules. Okay, in Nigeria, the main statutory document for accounting and organization, regulation of business in Nigeria is Companies and Allied Matters Act 2020. All right, so that act is available online. You can download it, all right, and go through it as a business or management student. So the rules and regulations basically for conducting business in Nigeria, you will see it in that Companies and Allied Matters Act of 2020. There are other legislations for specific industry, like for banks, you have BOFIA, Banks and Other Financial Institutions Act of 2020. All right, you have Insurance Act of 2003 for the insurance sector, and so on. There are so many of these laws for different sectors of the economy. Therefore, for financial reporting itself, we have International Financial Reporting Standards, IFRS, which is issued by the International Accounting Standard Board from time to time. About 2010, 2011, Nigeria adopted IFRS instead of our generally accepted accounting principles. Okay, so all over Nigeria today, every organization is preparing the accounting report in accordance with IFRS. So all these are some of the laws and regulations that regulate business accounting in Nigeria. Of course, you have what we call a RSBs, regulatory statutory bodies like ICANN, all right, ICANN and ANAM in Nigeria, also who are responsible for certifying people as chartered accountants in Nigeria. Okay, so exercise briefly explain the regulatory framework of accounting in Nigeria. All right, you should be able to do that by now. So let's continue. Bookkeeping and accounting. Like I said, bookkeeping is a subset of accounting. All right. So bookkeeping is the recording phase of accounting, the recording. All right. It is the classification and recording of business transactions in the book of accounts. The recording of the transaction is a routine task, therefore it tends to be repetitive. Accounting includes not only the keeping of accounting records, but also the design of efficient accounting systems, interpretation of accounts, development of forecasts. So you see, so a bookkeeper reports to an accountant in an organization. So basically, you know, if you want to look at the academic system, okay, maybe somebody that has a diploma in accounting or a certificate in accounting will be required to do bookkeeping, okay? But for you to be an accountant fully in Nigeria, okay, you need to have HND, BSc, be a chartered accountant. So you have more knowledge, okay? So apart from just recording, you can interpret, all right, what is being recorded, okay? You can set up accounting system for an organization, big or small. You can also provide forecasts, okay, that likely in the next financial year, this is how much revenue we're going to make. That's what makes you an accountant. So for a bookkeeper, the processes involved in bookkeeping include classification of business transactions using source documents. So if I'm holding a document, I should be able to know how to classify the transaction, all right? Is it expense? Okay, is it, am I debiting expense or am I debiting assets? All right, you should know. And this way, you know, it can be very confusing. Sometimes people make mistakes in real life, not textbook now. In real life, okay, people make mistakes. You are supposed to debit an expense account. You go ahead and debit an asset account. Okay, so a good bookkeeper will know how to classify business transactions using source documents, recording of classified transactions in appropriate subsidiary books or books of prime entry. So you are also be able to record transactions in subsidiary books, then posting of entries from subsidiary books to the ledger. All right, so the subsidiary books are like a general book. So for example, all credit sales, right? From January 1 to January 31st, you post them into subsidiary books. Then on 31st, you can now move those credit sales, all right, into sales ledger proper. Okay, so that is what we mean by, you know, posting of entry from subsidiary books to the ledger. So the subsidiary book of books of prime entry is like just, you know, you don't want to make the book too congested, so you create like a temporary book and post entries there. Then at the end of the month, you can now move and say, okay, total credit sale for the month of January, you know, you move it from the subsidiary book, then you move it to the ledger. Then the extraction of trial balance. Okay, you will know trial balance as we continue. So trial balance is simply uh, a balance that shows the total debit amount posted in the period of that we are looking at, and it's against the total credit amount, and it must balance, okay, because it's from the trial balance that we now prepare the final financial statements, like the statement of financial position, income statement, and the rest of them. So a bookkeeper will be able to extract the trial balance. So let's look at the scope of accounting. The starting point in the study of accounting is financial accounting, of course. So financial accounting is where the accounting really started. Businessman, I open a store, somebody comes to buy Coke, somebody came to buy Bonfita, you have to record them, okay? Drawings made by the owners of the business. So that's why it started, as financial accounting. Okay, then later, we now realize that we need to know what is going on in the organization itself. Just apart from reporting, we're going to make to external parties, all right, like shareholders, regulators, and the rest of them. We need to have information for management within the organization. So that is what led to management accounting. Okay, but management accounting will be fed by cost accounting. All right, so cost accounting, you actually want to know, it's not, you know, in financial accounting, you just say cost of the inventory, 100 million. Cost accounting wants to bring that 100 million down. All right, so how much of the 100 million is fixed, how much is variable? All right, so that is cost accounting. We want to see the element of cost, how cost actually operates within an organization. And like I said, that is very important also for management accounting. So if there are areas where we can reduce costs, we can manage time better and the rest. So all those are involved in management accounting. So cost accounting is very related to management accounting. Then of course, auditing is also an aspect of accounting. So most auditors are actually chartered accountants or accountants by profession. So once you understand financial accounting, you'll be able to audit a financial statement. Then of course you have government accounting or public sector accounting, okay, which is a bit different from the accounting you see in the private sector, because the procedures in government, in the public sector, are different from the procedures in the private sector. Then, of course, we are going to have tax management also. So, tax management is another field of specialization in accounting. Okay, so financial accounting involves an accounting process that starts with bookkeeping. Like I said, it starts with bookkeeping and ends with preparation and interpretation of financial statements. So, when you look at the financial statement, you will see statement of financial position, formerly called balance sheet. All right. So the statement of financial position will show us our assets, will show us our liabilities, will show us the capital and reserves of that organization. Okay. Then you have the statement of financial position, the income statement. Do we make profits? Do we make loss? What is the revenue? What are the expenses? What is the cost of goods sold and the rest? Then you have that to give us income statement. Then of course you have the cash flow statement. Okay, cash generated within the accounting period, cash used up within the accounting period. Then what is the amount of cash left at the end of the accounting period? So the cash flow statement or statement of cash flow is very, very important, because if you are going to depend only on financial accounting, you will not actually be able to know the liquidity of that organization. The company might make money, they might make profits, but the profit is not yet available as cash, because what they did was credit sale. So the company may make profit, and yet that company will still become liquidated if they don't have cash in time. So that is why we need the statement of cash flow statement. All right, so cost accounting is the procedure for accumulating data to provide information for managerial action. So that's what I said, that cost accounting actually feeds management accounting. So cost accounting is cost accumulation is the collection of cost data in some organized ways by means of an accounting system. So we want to know, how costs run in finance, how costs run in IT, how costs run in human resources. So that is basically what cost accounting is all about. Then we have management accounting, which provides the information for management to take better decisions. So management accounting is for internal consumption, while financial accounting is for external consumption. So they use management accounting information for the leaders in that organization to make decisions. Then, of course, like I said, auditing, we have to be able to provide assurance that the financial statement is true and fair, like he said in audit, so that a third party, an independent party, can look at the financial statement to confirm that what is being passed to the owners of the business is not a financial statement that is fraudulent. So government accounting is the process of recognizing and reflecting in the appropriate books of accounts and records government generated revenue and disbursed expenditure in such a way as to extract with ease relevant financial information vital for appropriate decision making from time to time and in compliance with laws and regulating government finances. We are talking about taxation also. So there are tax consultants, there are tax accountants, tax experts, right, that can be able to help an organization in tax planning. Of course, every organization is expected to pay tax as a corporate citizen. So you need tax expert to be able to look at your finances and draw up your tax liability for the year, and also be able to look at the relevant laws and tells you how to minimize your tax liability, which is also very, very legal. The need for accounting information. All right, we need accounting information because it provides information useful for making economic decisions. We need accounting information. We want to know, maybe somebody, a company has just announced initial public offer. You want people to come and buy their shares. What will you look for before you buy shares? You want to look at their financial statement for like 3, 4, 5 years. You want to know whether they are doing well before you make that decision. All right, it provides information to users for predicting, comparing, and evaluating the earnings power and financial strength of the business. So it's in an industry, I want to compare maybe First Bank with UBA. All right, UBA, I want to see their finances. I want to see which one is doing better. Well, I will take their published financials, audited financial statement, and compare by a period of time, so I can predict, all right, the growth of that particular organization. It is used to judge the ability of management to utilize the entity's resources effectively in achieving the goal of the entity. So we see cases of boards being sacked, boards of directors being sacked after the financial statement has been published. So you guys, giving everything you need and not achieving the results, please can we have another set of leaders to see what you can do. So it provides information to creditors for predicting and evaluating the cash flows of the entity. Now talk about liquidity. The fact that you posted profit does not mean you have cash. So creditors will be very, very much interested in your statement of cash flow to be able to know whether the money they have borrowed, they have lended to you, whether the money will come back or not. It provides management with detailed accounting data for use in planning and controlling the daily operations of the business. All right, I've talked about management accounting, I've talked about cost accounting. All right, so we need this all this financial information, all right, to be able to run the operations of that organization. It provides information to governments for determining the tax payable on the profit and other incomes of an individual or company, and for formulating fiscal policy. So government, so you have not paid your tax for 34 years, then you just hear knock on your door one day, FRS, okay, they are here and guys, we have not seen your tax for some time. Well, how would they be able to use to determine your tax liability? They want to see your financial statement, right? So from the financial statement, if you cannot give them a tax figure, they will use best of judgments. They call it best of judgment, and they determine how much you are going to pay. So they need a financial statement to do that. They form the basis of reporting on the activities of an enterprise as it affects the society. It serves as a basic instrument by which investors decide the securities they want to invest. I've talked about that. Before you buy shares of a company, you want to see the financial statement of that company. Now, let's look at qualities of good accounting information. All right, a good accounting information must possess the quality of relevance. Don't give me financial information that I don't need. Okay, so the financial information you give to people must be what is relevant for them. All right, must be what is relevant for them. Okay, so that means it's talking about usefulness. It must meet the needs of the user. Reliability, accounting information should be reliable. All right, so it should be reliable. Okay, the source of information must be verifiable. Then one source of evidence must corroborate the other. Information must be reliable. So if you tell me that you have non-current assets, okay, 100 million. Okay, by the time we look at the 100 million, I want to see evidence that those that you actually acquire those non-current assets. I want to see title of this. I want to see purchase receipts. So the information you give me must be verifiable in the financial statement. Comparability. Have you noticed our financial statement, published audited financial statement, is always in covering 2 years, if you have noticed. In fact, before IFRS, Nigerian financial statement always cover 5 years. You will see results over 5 years. But that is no longer done because IFRS does not really is the support of it. So, but at least give us 2 years. All right. So, if you're going to publish financial statement of 2021, you must also give us information of 2022. We must be able to compare the information over a period of time. Okay. Timeliness. Give us our accounting information on time. Okay. So, this is 2022, and you are still telling us that the audited financial statement of 2020, maybe 2018 is not yet ready. Something is wrong. Accounting information must be provided on a timely basis. Objectivity. Accounting information must not have bias, say window dressing or subjective judgments. All right, it must be objective. So you will not tell me that if you are looking at the financial statement from the point at which I'm looking at it, you will see what I am saying. Then something is wrong. All right. So if two professional accountants with the same experience can look at the financial statement and both of them do not agree, then something is wrong. Something is wrong. So an accounting information must be without bias. All right, must be without bias, must be without window dressing. Okay, so we add cases of what they call the creative accounting. So the revenue, just write a figure. All right, expenses, just write any figure. You are working towards a particular profit. So these things happen, but these things happen, but it's wrong. It's not supposed to be. Objectivity. Then comprehensiveness. Accounting information must contain just enough details for good understanding. The detail must not be too little, must not be too much. So you don't overflood us with information that is not necessary. But at least give us enough information that we need. That is comprehensiveness. So these are the characteristics or qualities that a good accounting information should have. So this is the end of Unit 1. I will be looking at Unit 2 in a subsequent video. If you have not subscribed, kindly subscribe now. Thank you.